G'day everyone, and welcome to the second video in week 8 of our Legal Ethics and Trust Accounting course. This week we've started our discussion of the financial side of a lawyer's duty to their client. In the first video we focused on the nature of legal costs, including the nature of a costs agreement and the way legal costs are determined. We also started talking about trust accounts, the fact that rather than simply racking up bills and sending them to the client, we often require the client to pay money into trust up front. But when they do that, the money is not ours. It's being held by us on trust. In this second video, we're going to look at the nature of trust money and the key principles that apply when a law firm holds trust money. Now, unlike most of the content of this course, the rules for trust money don't come from the solicitor's conduct rules. They're much more important than that. The rules for the management of trust accounts come directly from the Legal Professions Act 2007. Part 3.3 from section 236 to 298 sets out the general rules, and then part 3.3 of the Legal Profession Regulation sets out all of the detailed rules about how trust money has to be handled and how it has to be accounted for. Fortunately for lawyers everywhere, the Queensland Law Society has written out and made freely available the Queensland Trust Accounting Guide. A copy of it is with the materials for this week, but you can also download it from the Queensland Law Society website. It's very good. I often find this trust accounting stuff quite frustrating, but the QLS guide does make things a lot easier. In addition, it's worth pointing out that the major brands of practice management software, Leap is the one that I'm most familiar with, they all include modules for management of trust money, and those modules are all built on the requirements of the Legal Professions Act, and so they do make things a lot easier. But they're only helpful if you understand the underlying principles. So let's crack on with those. The first principle is that there are two types of money, trust money and not trust money. Identifying the difference between trust money and money that is not trust money is the heart of your ethical obligation. If you don't get that right, you can't get anything else right. There are different types of trust money, and we'll learn about those next week. For now, let's just refer to trust money in general. It is absolutely crucial that you know whether any particular money is trust money or not. Section 237 of the Legal Professions Act defines trust money as money entrusted to a law practice in the course of and in connection with the provision of legal services by the practice. So the first thing we're looking for is money entrusted to the law practice. This means, in essence, making an inquiry in our minds as to the intention of the person providing the money. Were they paying us? In other words, were they saying, you have sent me a bill, and here is money to satisfy the bill. The money is now your money and not my money. Or were they saying, here is some money. It is still my money, but I need you to hold it for me so that this matter can progress. If the person intends that the money should become your money, then it's not trust money. If the person intends that you should hold the money but it's still their money, then it is trust money. Second, the money has to be provided in the course of and in connection with the provision of legal services. So, for instance, some law firms have a multidisciplinary practice. They might, for instance, provide escrow services or mortgages or financial advice. Money received from clients in connection with those services is not trust money to which the Legal Professions Act applies. They might still have equitable duties in relation to that money, of course, but the Legal Professions Act would not regulate that money. So we have two steps. First, is the money being paid to us as our money, or is it being entrusted to us while still remaining someone else's money? If it is someone else's money, has it been given to us in the course of and in connection with the provision of legal services? Now, when I put it like that in the abstract, it sounds simple enough, right? If only. Sometimes it can be downright tricky to identify trust money. For instance, what if your firm sends a bill to a client for, say, $8,200, and then the client pays $12,000 into your firm's business account? Is that $8,200 to pay the bill and $3,800 extra to go into trust? Or is it $12,000 into trust and the money for the bill remains outstanding? I mean, look, obviously in that situation, you'd contact the client and you'd ask, but what if the client can't be contacted? What if they die in the meantime? What if they're a corporation and they become insolvent? It can get really tricky, and if you get it wrong, your practicing certificate is on the line. Fortunately, under Section 239 of the Legal Profession Act, where there is doubt, you can ask the Law Society to make an authoritative decision about whether money is trust money or not. So that's our first principle. There is trust money and money that is not trust money, and it's absolutely vital to know the difference. The second principle, and this one is basically holy writ. Trust money and money that is not trust money must never be mixed. You can't operate one bank account and keep trust money and other money in that account. The situation I mentioned a moment ago, where the client has paid what seems to be some trust money into our trust account, that situation does happen. You will see it. And you will see the firm's practice manager running around threatening terrible doom for clients who pay trust money into the business account. The moment that there is any mixing of trust money and money that is not trust money, immediate steps have to be taken to separate the trust money out and very clearly advise the client what we've done. In order to make all of this work, firms open a general trust account. This is a special type of account operated by approved banks. The account name must include the words Law Practice Trust Account, and the firm must notify the Queensland Law Society of the details of that trust account and the details of those people who are authorised to operate the trust account. Here's the good news. Until you're well into your career, you are most unlikely to be one of those authorised signatories. General trust accounts have one unique feature. They do not earn interest. And if you've already done your equity subject or your trust subject, I'm sure you can see why. It's a basic principle that a fiduciary cannot profit from their trust. Instead, and this is actually very cool, what happens is that all of the interest earned by all of the law practice trust accounts in Queensland, it's all paid into the Queensland Law Society's Fidelity Fund. This fund exists so that if any practitioner did the unspeakable and took off with their client's trust money or misappropriated the trust money, the client won't end up out of pocket. They can be reimbursed from the Fidelity Fund. It's another layer of protection that says to clients that they are safe when they leave money in the hands of a legal practitioner. The final principle that I want you to know for this video is that each client's trust money is separate. So consider this simplified scenario. We have $40,000 in our trust account. $20,000 of that belongs to our client Mohammed. His matter is currently stalled, and we know that we're not going to need to take steps for at least 3 months. We have another client, Sakura, who's just come to us with an urgent matter. She put $2,000 into our trust account, but the filing fee is $3,500. She's promised to get the extra money to us within 3 days. We think, no problem. We have plenty in the trust account. We'll take the extra $1,500 from Mohammed's money and reimburse it when Sakura pays us. He won't be disadvantaged. Bang! There goes your practicing certificate. Mohammed gave us that money to hold for his matter, not to use his money like some sort of bank. It's irrelevant that he wouldn't have missed it. It's irrelevant that Sakura paid up on time. We have breached our trust. That's professional misconduct. So, there's 3 basic principles of solicitors' trust accounts to get us started. Principle 1, there are 2 types of money, trust money and money that is not trust money. Trust money is money entrusted to a law practice in the course of and in connection with the provision of legal services by the practice. Principle 2, we never, ever, ever mix trust money with money that is not trust money. We operate a general trust account, and that's where all the trust money lives. Finally, principle 3, each client's trust money must be kept separate. You can't borrow from one to meet your obligations to another. In the next video, the final one for this week, we're going to talk about the extreme level of trust and professionalism required of every legal practitioner in relation to trust money. It probably feels a little bit like a lecture from mum and dad, but I promise it really is that important.